This video reviews Itochu Corporation's financial results for the first quarter of fiscal year 2026, covering the period from April to June 2025. Itochu is a major Japanese general trading company, Sogo Shosha, and one of the country's largest and most diversified conglomerates, which operates across a wide range of businesses. Along with Mitsubishi Corporation and Mitsui & Co., Itochu forms part of Japan's Sandai Sogo Shosha, the three leading general trading companies. Summary of first quarter FYE 2026. Consolidated net profit rose significantly to 283.9 billion yen, a 37% increase year over year, marking the highest first quarter profit ever and achieving 32% of the full year target. Core profit fell slightly to 181 billion yen due to negative foreign exchange and resource price effects, but performance in the non-resource sector remained stable, supported by strong results in the textile and food divisions. Core operating cash flows increased to 245 billion yen. The net debt-to-equity ratio remained stable at 0.52 times. The impact from U.S. tariffs was limited, but ongoing geopolitical and economic risks are noted. Itochu continues shareholder returns, aiming for a 50% payout ratio with 200 yen per share in dividends and 170 billion yen in planned share buybacks, of which 40.1 billion yen has already been executed. Although there were some one-time gains, the progress rate reached 32%, indicating steady performance in line with expectations. As with other general trading companies, the resource segment and the appreciation of the yen led to a partial decline in profits. Net profit by segment. In the first quarter, the decline in resource-related profit was offset by continued strength in the non-resource sectors. The textile segment experienced a year-on-year increase, mainly due to the consolidation of apparel brand Decent and its strong overseas performance. The machinery segment saw a slight decrease, affected by weaker results in ship-related businesses and a decline in earnings from used car sales and construction machinery. Metals and minerals had a significant decline in profit due to lower iron ore and coal prices, foreign exchange valuation losses, and delayed recovery in steel-related markets. The energy and chemicals segment recorded a modest increase, supported by stronger LNG transactions and growth in the film and packaging material businesses, although some upstream energy operations suffered from lower prices and forex impacts. The food segment achieved a notable increase, thanks to higher transaction volumes and improved profitability in provisions-related businesses and strong results from Dole. General products and realty reported a significant decrease, mainly due to the absence of large-scale real estate sales and weaker performance in North American construction materials. ICT and financial business remained nearly flat, with gains from CTC and insurance agency operations offset by weaker results in mobile-related businesses. The eighth company, driven by FamilyMart, showed a clear year-on-year increase due to higher daily sales and improvements in store operations. Lastly, the Others category posted a large gain due to extraordinary income from the sale of CP Fand. Overall, the drop in coal prices has had a substantial negative impact on earnings, a trend observed across other major trading houses as well. The increase in Itochu's net profit was driven primarily by extraordinary gains and strong performance in consumer-oriented non-resource businesses. FYE 2026 First Quarter Business Results Review. First quarter consolidated net profit reached a record high of 283.9 billion yen, marking a 37% increase year over year. Of this increase, 98.5 billion yen came from extraordinary gains, including the large gain from the sale of CP Fand, which is a Hong Kong-based agribusiness company, mainly engaged in animal feed and livestock operations in China and Vietnam. Although foreign exchange losses and declining resource prices weighed on earnings, core profit from non-resource segments rose by 5.5 billion yen, offsetting a 4.0 billion yen decline in resource segments. The non-resource segment accounted for 90% of the total, up from 77% in the previous year, supported by stronger performances in areas like energy and chemicals segment, Family Mart in the 8th company segment, Descent in textile segment, and food segment, despite weaker results in areas such as general products and realty and machinery. The increase in consolidated profit was primarily driven by one-off gains and steady performance in key non-resource businesses. Fiscal year 2026 shareholder returns. Itochu is aiming for a total payout ratio of 50%, which surpasses its previous management policy target of 40% or more. For the second consecutive year, this goal is being exceeded. Dividends are set at either 200 yen per share or 30% of consolidated net profit, whichever is higher. Itochu has been actively executing share buybacks, with the amount increasing to approximately 170 billion yen for fiscal year-end 2026. Historical data on dividends and total payout ratios shows a general upward trend, reflecting Itochu's commitment to increasing shareholder returns in line with improved business performance. Stock price. This is the Japanese yen base chart for the last 1 year. The Japanese yen stock price is 7,835 yen as of August 1st, and the US dollar stock price is $104.79 as of August 1st. The stock price has recently been trading in the 7,000 yen range. Current PBR is 1.93, and PER is 12.3. Dividend yield is 2.55%. Compared to the last few years, considering PBR, PER, and dividend yield, current stock price is relatively still a little bit higher. Conclusion. In the first quarter, Itochu delivered record-high net profit, driven by extraordinary gains and the continued strength of its non-resource businesses. While profits in the resource segment declined significantly due to falling coal and iron ore prices and foreign exchange losses, non-resource segments such as food, textiles, and Family Mart convenience stores showed strong and stable growth. Shareholder returns remain a key focus, supported by strong cash flows and a progressive dividend and buyback policy. Overall, Itochu is progressing steadily, supported by a well-balanced business portfolio and continued focus on stable, non-resource-driven growth.